appreciate you all coming out. I think you're going to get a lot of value out of tonight's presentation. We've got a couple of experts in 1031 exchange and opportunity zones to talk to us about those two types of ways to do tax deferral, or I suppose also potentially tax-free. And so I think it's going to be a really good panel discussion. This is our fourth event so far. So we're a relatively new FIBI chapter. We're the Culver City Westside FIBI chapter. So appreciate everybody coming out and bearing through the traffic. We good?
We're good.
Should be good. Got to turn it on.
Hello, hello. If you turn it on, that helps.
Yes.
So as Zach was saying, welcome to FIBI Westside, our April meeting. Let's start with a show of hands. How many have been to any FIBI event ever before? Good. And how many have never been to any FIBI event? Thank you for coming, everybody. We'll do a little bit of a commercial about FIBI.
Oh,
Yep.
is he okay?
I'm good. So FIBI was started by a bunch of investors for investors. So we get industry professionals to talk about their specific niche and what they do all day, every day. So there is no one here with a sales product to pitch or an educational product to pitch. We are all stating our personal opinions about what we do for a living. So as such, no one on the panel tonight is giving you any tax, legal, accounting, or any other advice. We are just sharing our personal opinions. So about myself, I am Jeff Wagner, one of the 4 hosts of FIBI Westside. My wife is one of the other co-hosts, but she is recovering from surgery that she had last week, so she is not here tonight, but she is doing great.
Good.
So I'm a 4th generation real estate investor. My wife and I have a company called Just Home Property, where we do apartment syndications for near immediate positive cash flow. And if you'd like to hear more about that, we can talk to me during networking. Zach, you ready?
Yeah. Hi, I'm Zach Winter, and my business partner Mark Rios is back there running the camera. Most of you know us. And we have a real estate investment company as well, focused on multifamily, student housing, etc. Currently have an offering in Kansas City if anyone's interested in talking with us about that. Happy to do it. So yeah, I'm really happy to have Bill and Mayor here today, and I'd just like to kind of introduce them. Bill's the President and Chief Executive Officer of Exeter Group of Companies. He's been in the banking, trust, and fiduciary services industry since 1980. He began specializing in real estate tax strategies in 1985 with a specialty emphasis in 1031 and 1033 exchanges, as well as self-directed IRAs. He's written, lectured, taught, and trained investors extensively on 1031 and 1033 exchange transactions, DSTs, Delaware Statutory Trust, and like-kind replacement property solutions. So thanks very much for coming out. Really appreciate it.
My pleasure. Glad to be here.
And I'd also like to introduce Mayor Nazarian of CKR Law. Mayor's a transactional tax attorney, and he's uniquely trained with top regional and national tax firms. His clients benefit from his breadth and depth of accounting, legal expertise, and exposure to a wide range of businesses and structures. He uses this expertise to assist business owners in developing optimal tax strategies at all stages of an entity's life cycle and formation throughout operations until sale or dissolution. Thank you, Mayor. Really appreciate your coming as well.
Thank you, Zach, and thank you guys for coming out.
Okay, great. Well, why don't we kick it off, and maybe we can talk basic at the kind of 10,000 foot level. And Bill, just tell us essentially what's a 1031 exchange, when you'd use it, and then there we'll have you get into a little bit of the high level opportunity zone.
Okay, sure. Out of curiosity, how many people have been involved with the 1031 exchange before? Just like 2 or 3, maybe 4. Okay, great. Well, the 1031 exchange allows you to sell your rental, investment, or business use real estate and defer the payment of your capital gain, depreciation, recapture taxes, and avoid the Medicare surcharge, the Obamacare tax, by reinvesting in other replacement properties. So it really allows you to sell your assets and reposition in assets that put you in a better position, which of course you would have to define what that means. So it really allows you to shift your portfolio around without incurring any federal or state taxes, as long as you follow all the guidelines for the 1031 exchange.
Great.
To follow up on what Bill said, and just, I guess, to gauge, everyone's familiar with kind of the basics of what a gain is and the difference between basis and the difference between recognition. No, okay. So just to kind of go through a little bit of that basic. Your starting point in an investment is what establishes your basis. It's what you bought the asset for. You can add to that with additional improvements, additional money that you put in to make it better, to fix it up. So at a very basic level, that's your starting point, what you put in. What you end up selling that asset for is your recognition, is ultimately the high watermark where you are going to determine gain. So the difference between your investment, that added improvements, is your basis. What you sold it for, that recognition, is your realization, and the difference between the two is your gain. So what Bill is referring to is you're getting the opportunity to defer that gain with a 1031 exchange. Opportunity zones also provide tax deferral, but they add to that with the opportunity, and I'm going to use that word, pun intended, and it's very applicable, the added opportunity to have gain deferral, gain elimination, and gain reduction. So what does that mean? That means that when you take a gain, and I'm going to get into what a gain is a little bit later, but when you take a gain and you invest it into an opportunity zone structure, you're getting a deferral for a certain period of time. If you hang in there long enough, you'll get a reduction of that gain. And if you hang in for an even longer amount of time, you get gain elimination down the line. So we'll get into some of that later on, but just at a very high level, opportunity zones allow this potential for 3 ways to get rid of gain: defer it, reduce it, or eliminate it.
That's great. Jeff, did you want to?
I just want to add one thing. We have questions that we prepared for the panelists. We're going to go through a little of them to provide some basic understanding for everybody in the room. And then feel free to ask questions that would be a benefit for everybody in the room.
Yep. Sounds good. Sounds good. So one of the questions when I was chatting with you guys that was raised is, and I think Adrian, you asked this. So with a 1031 exchange, the property, your downlay property or the property you're selling, there's an understanding that you have to have an intent to hold it, you're not flipping it. And there's a question about how long you have to hold it. There may be some general rules, but there's no hard and fast rule about whether it needs to be a year or so. And the question is, what are the rules with respect to what you're selling as the downlay, or the property you're selling and you want to transfer your basis over in an opportunity zone?
You want to cover it from a 1031 first?
Sure.
Okay.
Yeah.
So from a 1031 exchange perspective, you hit the nail right on the head. It all boils down to your intent. And a lot of you have probably heard or read different articles where they say things like you have to hold title to the property for 1 year or 1 year and a day or 24 months. And we'll get people who call us and say, okay, I've talked to 3 or 4 people and I've received 3 or 4 answers. So what's the real story? And the real issue is the code.
And the real answer is,
And the real answer is it depends. Yeah, my staff really hates that answer. So it really does, it depends. In our world, there's a lot of gray area. So the code, the regs, really do not address any length of time. There's no specific holding period required. What it does say is you have to have the intent to hold the properties for either rental, investment, or business use. So that's really the requirement. So when we're talking to clients about that issue, it really depends on your specific fact pattern. If you have a really plain vanilla 1031 exchange, you're selling rental property, you're gonna do a 1031 and you buy rental property, 1 year and a day is probably sufficient because you straddle 2 tax returns and you've got really solid proof that was your intent, was to hold as rental. If you're gonna do anything that's a little bit outside the box, for example, some clients will sell rental property, do a 1031 exchange, buy other rental property, rent it for a period of time, and then ultimately move into the property as their primary residence. But that's a little outside the box. It's actually fairly common, but it's outside the box. So in that case, you'd probably want to rent it for 24 months. That straddles 3 tax returns, so it's more solid proof that that was your intent. You do not want to document that your ultimate intent is to live in the property. That will be kind of the last nail in the coffin. So it all boils down to what is your intent. So certainly the longer you hold title to the property, the safer it is, the easier it is to document that your intent was to hold for rental investment purposes. Well, let's talk about that real quick too. A lot of investors buy property and they have the intent to rehab it and fix it up and then sell it, what we call flipping. So with that, they're really holding for sale. The intent is to buy, to rehab, and sell. It's really treated as inventory in a real estate business. So you're not holding for investment, you're holding for sale. And that typically doesn't qualify for 1031 exchange treatment. Similarly, if you're a developer, contractor, builder, you typically buy, you build, you sell, and you're holding for sale, you're not holding for investment purposes. Now, in both of those cases, if you bought, rehabbed, and then held it as rental property, then it would qualify because your intent was to hold for rental as opposed to sell it. Same with the developer. If you bought and built and held it and rented your single families or whatever you built, then that would also qualify. So it's not the length of time you hold title to the property, it's your intent. And if you get audited, can you show or demonstrate that that was your intent?
And before I get to you, Mayor, on the timing, let's also talk about the like-kind component of 1031.
Out there on like-kind property as well. In fact, it still amazes me when I read curriculum or articles or websites, and they still say if you sell a condo, you have to buy a condo, or sell apartments, you have to buy apartments, and it's absolutely not true. Like-kind literally means you're selling real estate, you have to buy real estate. That's all it means. So anybody who tells you otherwise, they just don't understand the 1031 exchange process. So really the important thing is to make sure you're selling and buying real estate. That's relatively easy, although it does include things you wouldn't think about, like air rights, water rights, mineral rights, certain types of oil and gas interests, fractional ownership properties like syndicated tenant and common investment properties or syndicated Delaware statutory trusts. But as long as you're selling real estate and buying real estate, the critical component is the qualified use. Is it rental, investment, or business use?
Mm-hmm. And then similarly with 1031, like you can buy and sell other things other than real estate as long as they're the same like kind?
Good question. You used to be able to up until January 1st. So before January 1st, personal property would qualify. So anything that was non-real estate. We did a lot of exchanges on things like aircraft, water rights, livestock. We did a lot of fun stuff with livestock. Our most bizarre exchange was an exchange of a meteorite. We did an exchange on a baseball franchise. We did a lot of stuff, but the Tax Reform Act eliminated personal property. So you could only 1031 exchange real estate going forward.
They did just add sports players.
That's true. That's true. You can't exchange. I'd like to exchange a sports player occasionally.
How do you even get a sports player?
Athletes, you can trade athletes.
That's true.
So Myra, so tell us a little bit about opportunity zones and the timing for the downlegger property you're selling, and
Let's start a little more basic.
Sure.
Tell us about the basics of an opportunity zone investment.
All right. So how do you establish an opportunity zone investment? Starting point is a gain. You've got a gain, and it's pretty broad. It's any kind of gain. So it's gain from real estate, it's gain from sale of livestock, sale of Bitcoin, sale of stocks, whatever. You've got a gain. Now you don't want to pay tax on that gain, so opportunity zone could be a good fit. What's the first step? The first step is to invest that gain into an opportunity zone fund within 180 days. So that's your first kind of timing marker. we'll get into what it means to actually invest into an opportunity zone fund, but just focusing on the timing aspect of things, you've got that time from the gain trigger event, 180 days to invest the money into an opportunity zone fund. The rules do allow some flexibility depending on where that gain is starting. So if the gain is starting through an LLC, for example, then it's treated, that is treated as a partnership, then the rules there allow some more flexibility. So what I want to highlight here is if you've got a partnership, an LLC that's taxed as a partnership that has a gain event, the timing is 180 days from the time that either the partnership recognizes the gain or the partner recognizes the gain. So for example,
What does that mean? The partner recognizes the gain?
so yeah, let me elaborate. For example, the LLC sells the property in February of this year. It's got 6 months to invest that gain into an opportunity zone fund to defer. So if the LLC, the partnership, is going to be the recognizing party of the gain, it's going to be the one that goes ahead and invests into the opportunity zone fund, then you mark February 6 months to August. You've got that time frame. If instead the partnership, the LLC, doesn't do anything with opportunity zone and decides we're just going to pass this gain through to the individual partners. So at the end of the tax year in December, we're going to report, partner A, you've got so much gain from this transaction and any other transaction that's occurred within the partnership over the course of the whole year. And that partner then has 6 months from December 31st, when the partner is recognizing the gain that happened in the partnership, to make its opportunity zone investment. So in theory, you know, if you've got a January sale in an LLC that's taxed as a partnership, you could have till June of the following year, you know, a year and a half. It's a big difference as opposed to the 180 days that you're very hard deadline with respect to 1031. Yes.
Okay, so I have a scenario like this. So I have an LLC and we have a flip and it's going to be going on the market soon. So with two partners. So say that we each take what we've made off of that, and I decide I want to go and invest that into an opportunity zone. I put a certain amount of money into that deal, right? So do I have to invest my principal investment and what I've made, or can I just invest what I've made?
Great question. Yeah, great question. So the question is, just to narrow it down, is do you have to invest the principal that you're getting and the appreciation, that gain, or do you just have to invest the portion of the gain? So the benefits of opportunity zone apply only to the gain portion that is invested, that's reinvested, and it's done pro rata. So if you've got $20 of gain, but you want to buy a $100 property, then your benefits going forward are going to be 80-20. It's based on how much gain you're deferring, is how the benefits of opportunity zones apply going forward.
Okay, and is there a minimum investment into an opportunity zone? Typically, is it typically 50,000?
No minimum. There is no minimum.
Huh.
But remember, they're all
$1 of
second
gain,
level details.
$1 of gain, $1 deferred, $1 reduced, $1, well, not eliminated. The elimination comes after that investment, so it's the future appreciation.
Interesting.
And what about, so with a 1031 exchange, there are certain rules with respect to, you have to buy an equal or greater property, and how does the debt on the down leg versus the up leg work? And how does that apply at all in an opportunity?
I mean,
zone?
opportunity zone is really easy. It doesn't. The opportunity zone, it's just the gain. So if you've got debt, if you've got all these other variables that are occurring, you don't acknowledge any of those. It's just the gain portion that you want to defer.
You know, on the 1031 exchange side, it's obviously a little more complex. So effectively, I'll get kind of into the weeds here, because some people like to get into the nitty gritty and some people want to get more high level. But let's say you sell an asset for $1 million, and the question is, what do I have to reinvest through a 1031 exchange to defer all the taxes? And technically, the answer is it's your net sale price, and we have to be careful how we define that. So net sale price does not mean you subtract all your closing costs in the settlement statement. It's not everything, it's just certain items. and it does not mean you subtract any debt that you pay off on the sale. So you take your closing costs, or you take your settlement statement, and you really have 3 buckets on your settlement statement. So you have routine selling expenses like broker's commission, title, escrow, documentary transfer tax, recording fees, in this case an exchange fee, things like that. Those are permissible expenses and you can deduct those, and that, so you take your $1 million sale price minus your routine selling expenses, and that equates to your net sale price. So if you sell for $1 million, your net sale price is going to be somewhere around $950 probably. The other 2 buckets are not permissible expenses. So the second bucket would be any loan-related payoffs, like a demand statement fee, anything like that. You could certainly pay those out of the net proceeds, but it's not permissible. So if you pay any kind of loan-related costs on the payoff, it does not harm the 1031 exchange, but it is taxable. So it's usually a minor amount, but it'll be a taxable item, and you just have to kind of be aware of that. The third bucket is any kind of operating expenses, prorated rents, prorated property taxes, HOA fees, things like that. You can pay those out of the net proceeds as well, but it again will be taxable. So a couple kind of to expand on that, just before you close, get your estimated settlement statement, calculate those 3 buckets. The second and third bucket are usually a net debit, and if you want, you can put out-of-pocket cash into escrow to cover that net debit, and then because you're putting cash in to cover those non-permissible items, it won't be taxable. So going back to what you have to reinvest, it's $1 million sale price minus your first bucket, your routine selling expenses. That gets you about $950. On the buy side, it's whatever you buy, whether it's 1 property or 2 or 3, the total or aggregate amount of what you buy has to be equal to or greater than that $950. So on the purchase side, it's going to be your purchase price plus your routine purchase costs, which are your broker's commission, title, escrow, etc. Now going back to the $1 million sale price, let's assume it was a $600,000 debt, $400,000 in equity. There's a lot of information on the internet that says you have to replace your equity or reinvest your equity, and you have to replace your debt. That's partially true. Or it's mostly true because most people don't have cash in their pocket. But in theory, you sell for $1 million, you could buy another replacement property and pay all cash, and that would qualify because you're replacing equity with the equity out of the sale, and you're replacing debt with new out-of-pocket cash or equity, so that would qualify. In most cases, people don't have cash laying around. So in that example, you'd sell for $1 million, you'd buy for $1 million, you'd reinvest your $400,000 of equity, and you'd get a new loan for $600,000. But that $600,000 debt can be new debt, all cash, or a combination thereof. So the 2 real requirements are trade equal or up on value at the 950 level, reinvest all your equity, and the difference will be either new debt, new cash, or a combo of both.
And you can trade like down, right? But you just have to pay boot on the difference. Is that
good question? Yeah, there's a lot of information on the internet that says you have to trade equal or up, and you have to replace your debt, etc. You can trade down in value. It does not hurt your 1031 exchange. So maybe you sell for $1 million, you buy for $800,000, you trade down on purpose. You will still have a valid 1031 exchange, but you've traded down by $200,000. That will be taxable. They do not prorate your cost basis, or you can't use your cost basis to offset whatever you pull out. So anything that you trade down by or any cash you pull out is taxable. It's applied to your depreciation recapture first, then your capital gain. The last thing you get back is your cost basis.
Thanks. So I know you guys were chatting before the meeting about ways in which you might use a 1031 versus an opportunity zone. Any insight into here's some intriguing areas where a 1031 might be more appropriate or an opportunity zone?
That's what we're laughing.
Well, yeah, I mean, I think one thing to cover maybe a little bit or touch on is the high level.
Okay.
With respect to, I think 1031s, a lot of people are generally familiar with how it works. I want to kind of allow either an opportunity or kind of give more of a narrative of what an opportunity zone investment ends up looking like and kind of what the steps are. So what I alluded to is the investment, you've got to reinvest that gain as much as you want to defer within 180 days. If you hang in there for 5 years, then that investment gets a 10% haircut. So what that means is if you had $100 of gain that you had to otherwise recognize, you invest that $100, you wait 5 years, then you're only gonna pay tax on $90. You're getting a 10% haircut. If you wait an extra 2 years, 7 years total, you get another 5% haircut. So that's 15% gain reduction. So you deferred gain for 5, 7 years. You have gain reduction if you hang in there for 5 or 7 years. And the big carrot in all this is if you can hang in there for 10 years in the investment, then you're getting the gain elimination. I'll take your question in just a second. Gain elimination on that future appreciation. So I invest $100, 10 years from now, that 100 is worth 200. I'm gonna pay the tax on that first 100 minus 15, 85. I'll pay tax on 85. The remainder of that appreciation, up to 200, is all tax-free. Did you have a question?
Yeah, so can I do a 1031 exchange from one opportunity zone investment to another?
Yes, yeah, that's a great question. And to segue into now, how can a 1031 and an opportunity zone work together? In order to,
It depends.
It depends, yes. In order to get the benefit of the opportunity zone, you have to stay in an opportunity zone.
But there's more details about staying in.
Yes, and so we have a lot of clarification on what it means to be invested in an opportunity zone, what an opportunity zone business is, what opportunity zone property is. And so to expand a little bit, opportunity zones allow you to invest in real estate, but they also allow you to invest in a business. So that's a very important thing to keep in mind here, because what the opportunity zone locations are around us. It's Koreatown, Hollywood, Culver City, down by the Coliseum. All of these areas are considered opportunity zones. So the real estate market in those areas is very hot and has appreciated substantially just in the last year and a half. What people kind of forget about or don't really focus on is the fact that in order to get the benefits of deferral and elimination that opportunity zone provides, you could just start a business in an opportunity zone. And the money that you invest in the opportunity zone is deferred. And if you grow that business and sell it after 5, 7, 10 years, you're still getting the benefits of opportunity zones. Now, how does that come back to the other side, which is the big play for real estate, and what we were talking about before was you have a stock portfolio. You've cashed out on crypto and you've got all this gain and you want to diversify. You want to get into real estate because we're in Southern California. It's real estate. I mean, we're not hedge funds. We're not, a lot of the wealth is real estate. That's where it's been created and sustained for generations. So ultimately, yeah, you could do a business, you could do these other things, but it's about real estate. So what's the opportunity? The case study that I had is a client sold his crypto gains in the beginning of January. He had $10 million in cash, all gain. He bought it $5,000 5 years ago, so lucky guy.
Bastard.
And he's got this gain. He's like, what do I do? Well, what do you want to do?
That's a big gain.
Right? It depends.
Big tax.
Big gain. For them, it worked out because what they were gonna do anyway was buy some property to run their business out of, and their business was already in Koreatown. So for them, it was kind of really obvious. Like, take the gain, buy some property in the opportunity zone. We're gonna run our business out of the opportunity zone, and we've deferred the gain. We're not gonna be selling this property for a while, so all the benefits will come into play. So now, to your question, Vlad, you've got a property and you want a 1031 out of the opportunity zone. So if you 1031 out of the opportunity zone, you've triggered that deferral and you've lost the benefits of that gain elimination. But if you 1031 into another opportunity zone property, then you could retain those benefits going forward as long as you're staying geographically within another opportunity zone.
Can I ask a quick question? So on the opportunity zone definition, and then the Koreatown, Inglewood, the South Central, who's defining these? Or is it set by income criteria? And has it evolved over time? Will it change 10 years from now? Is it the national government that's setting these these designated areas?
So the question was, who defines and establishes the zones, and can it change? Will it change? The zones were based on historic census data from, I think, 2005. So that's why you're seeing areas that are already gentrified, like Koreatown, included. But it was based on the income data from 2005. And that data was provided to governors. And so governors in each state were allowed to take that data and say, okay, yes, 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 yes. So it's established for now. If you're in any of those areas, you're kind of grandfathered in. The anticipation is that it's not going to change, at least not in the life of the current rules. You know, if they come out with a new set or they expand it, there might be new areas. But as of now, it's a set geographic area that's already been picked by the governors in each state. And there's a couple interactive maps where you can kind of zoom in and say, you know, I'm looking at this area, is it the zone? Or if you have an address, is it the zone? That'll kind of give you a general sense whether the property is in or outside the zone. But to be sure, you want to confirm that that tract, you know, the actual specific tract is part of the zone before you actually go forward with the transaction.
If we go to Zymus, will Zymus have that indication?
They might have that overlay. I don't remember. I've got a couple of other resources that I look at. There's one on the California Finance website.
Google.
Yeah, I mean, if you
Google
Google it,
knows.
there's a couple
Every
of
state.
Listed, okay.
Yeah.
So, yeah, I just wanted to ask a follow-up question with this example of your client who invested in Koreatown. Did he acquire a property or open a business, and how did that relate to the requirement of putting in, you know, the improvement value equal or greater?
Yeah, so with respect to the improvement, so one of the other rules is when you buy property, and property could be real estate or it could be business property, you have to invest as much as the cost of the property to improve the property. So with respect to real estate, the carve out there is if you buy a building and the land value is $1 million, the building value is $500,000, the investment is based on the building value only. So you've got to put another $500,000 over the course of 30 months to improve that property. So it is a strict requirement with respect to the substantial improvement in order to retain the benefits.
And do you have that same requirement if you're opening a business in an opportunity zone? How does the improvement work there?
So with respect to the business, you know, if you're starting a business, if it's a brand new business that you're starting from scratch, then there isn't that substantial improvement requirement. If you're taking over a business, then you've got to look at the property, the business property, what kind of business is it, and the equipment, machinery that needs to be upgraded, reinvested, furniture, fixtures, etc.
Cool.
Were there any questions from the audience?
Yeah, Bob.
Yeah, so if we want to defer 100% of tax, and you say it takes 10 years in opportunity zone, right? Let's use that for our example. So if I have one building for 5 years, and then I do 1031 exchange to another building in the same opportunity zone, will they accumulate in the 10 years, and I'll get 100% deferred?
Right, that's exactly right. So if you stay within the opportunity zone, I'm sorry, let me repeat the question. Vlad's question was, you know, if he's got a building, he buys in the opportunity zone, he 5 years in, he decides there's a better building that's also in the opportunity zone, and he does an exchange for that second building, does the holding period accumulate between the first and the second investment? The answer is yes. You're able to continue the benefit from that first investment through transfer it to the second investment. There's a couple ways to do that. One is if you're just using the same entity, if you use the same LLC and it's retaining that same operating structure, it makes it a lot easier. But even if you didn't, you'd still be able to flow it up to the individuals.
It has to be the same opportunity zone or
any opportunity zone. So it doesn't, like, if you're Koreatown, you don't have to stay Koreatown. You go to Florida or New York, wherever. Or
Does he have to invest more in the new building?
No, so you have to invest as much as you want to keep deferring. So if you want to defer that 100%, you need to make sure that you continue deferring that 100%. So for example, if you, well, I haven't really thought of it this way, but I guess if you bought that building for $100 of gain and it was worth $150 in 5 years, if you were to sell at $150, the easy answer is buy another building at 150. But what if you sold for 150 and bought another one for 100 or 125? What happens to that differential? Do you have to recognize that gain? And I don't know off the top of my head, but my educated guess on this is, to be conservative, you'd probably take a pro rata, and you'd say, I'm gonna have to recognize some of that.
He'd have to recognize some, and you have to pay tax on some, because he's only been in
But
it
it
5
doesn't
years,
blow-
so it's
yeah.
not all deferred.
Right, but it doesn't blow it up.
Right.
And the current gain that you're deferring is gonna be triggered in 7 years, and the gain on the new investments will be held for the 10 years and tax-free, correct?
Correct.
But you have to improve the value too.
Of the subsequent property?
Yeah.
I don't think so, because what the rules do allow is, if you are rolling into another property, I think you're getting the benefit of that first improvement. But
Doesn't that defeat the purpose of the whole opportunity zone though?
no, because you're already in the zone.
What was the question?
Oh, sorry. Getting too far ahead of myself. So the question was, do you have to improve that second property?
That's the purpose of opportunity zones, to improve the.
It is to
The
improve
zone.
the zone, but if you're already in the zone and you're now moving to another property, you've already done your part, and you're just retaining your interest in the zone, and you're taking advantage of just a straight 1031 to move to the next block or next location. But I caveat, I haven't absolutely confirmed that,
Yeah, it
so.
sounds like a loophole in the zones.
In the back.
I heard you reference Opportunity Zone Fund earlier. What do you mean by fund versus just going and buying a property inside of an Opportunity Zone?
Thank you. The question is, what does Opportunity Zone Fund mean? I mentioned that earlier, but I've kind of been going fast around it. It's not, fund is just a loose term for the entity, the upper tier entity that you're gonna put your deferral money into. So it could be a corporation, partnership, an LLC taxed as a partnership. It can't be an LLC that's a disregarded entity. You need at least 2 members or shareholders, or members. If it's a corporation, it could have a single. So the fund is just the upper tier entity that we're referencing. And below that, you would typically still want to follow the basic rules of having an LLC for, asset protection between the property and the owner. Question?
Okay, so if this flip that I'm doing, it's in Culver City.
Okay.
So that puts it in an opportunity zone?
Possibly. There's a sliver of Culver City. It's not all of Culver
Okay, it's
City.
in Blair Hills.
I don't know where that is.
Good chance it's included, but you gotta
Okay.
check.
But
Okay.
you can go, Google the address, Opportunity Zone, see if it shows up.
Okay, so say,
But you already own it, so the benefit is not necessarily for you as the
well,
seller,
my LLC owns it,
right?
and I'm one of the 3 people that are partners in the LLC,
Right, but you already own it.
right?
It's when you buy into it, you've got to, in order to, if you've got property that's already in an opportunity zone, the benefit only applies if you use gain money.
Right,
And
but
you
we're
buy
about to
the property.
sell the new house that we built.
Okay, sorry,
Okay.
go ahead.
So no worries. So then say I take my little piece, and like, are there people who have funds in Culver City, or am I not or am I misunderstanding? Are there people who have funds in Culver City where I can say, I don't feel like buying another house to flip in Culver City. I want to put this, whatever. It's not going to be the hugest profit, but whatever it is, into something else with some other people where they manage it and they're like honest, decent people that I can vet.
Right.
How does
So-
that happen?
So the question is, are there funds out there that you could then invest into for the benefit of Opportunity Zone benefits, get the benefits, without you being the individual owner, operator, manager of the property?
Right.
The answer is yes, there are. So I've got clients that are on both sides, that are doing their own individual funds because they're gonna buy the property and they're gonna redevelop it and they're gonna hold on to it and rent it. They're syndicating,
Right.
so they want other investors. I've got both of, it's all the typical real estate and business scenarios, but with the added layer of opportunity zone benefit on top of it.
Huh.
So there's even a couple of the bigger banks that are getting into it at the highest level. So you've got like the UBSs and the JP Morgans that are creating funds that are investing in hotel properties. And so they're doing it at a massive scale for their upper tier investors. But that's like, the concept still carries down to this level. If you've got 50 grand and somebody's doing a syndication that's in an opportunity zone and nobody else wants to take advantage of the opportunity zone benefit, but you do, you can.
But then it could be in any opportunity zone, or it has to be in Culver City?
Any opportunity zone,
Okay,
anywhere across the country.
Is
sweet.
there a resource that shows the investments in opportunity zones? Can you see who's invested where and how much they've invested?
I haven't seen one yet.
I haven't seen that.
What I have seen is a rating tool. There is out there that there's a group that kind of has compiled data and said, you know, this opportunity zone is number one. This specific tract out of, I think there's almost 10,000. This one's number one. This is number 98. So they've kind of qualified and said this is, you know, based on all of these criteria, the hottest or the best to get into, but not to the level of value and, you know, who's invested how much into what.
And what is that tool called?
I've got the link on my computer.
Oh.
I mean, I'm happy to share it. I can thing it. I don't have the full web address memorized.
Thanks. No worries.
So going back to the history of all this, so when Palmer, construction, all that stuff happened downtown, there were no opportunity zones in downtown, right? When that rush of investment went in 2004, 5, 6, 7, 8.
The opportunity zone started December of
With
17.
Trump,
So it applies to any investment January 1st, 2018 going forward.
Okay.
And does it sunset? I had heard that there's a sunset at the end of the year, but it could get extended.
2026 is the sunset. So it's not the end of this year.
Okay.
So that means you have to have major investment starting by 2026.
Correct.
But the
And
benefits
then
are
it goes for
permanent.
10 years minimum till 2036 to get all the benefits.
So it's 10 year. If you hold 10 years, you get that gain elimination that we were talking about, up until 2047. If you keep holding past 2047, then up until that point, there's a trigger event and you're getting a step up in basis to the value of 2047. But appreciation beyond that is taxable.
Although currently, if they make the investment in 2026, the current gain would not be deferred at that point.
Right. So the current gain is deferred until the later of 7 years or 2026. So at the end of 2026, that first level of gain that you deferred will have to be paid at 85%. So you're getting a 2 haircut.
And the savings, the maximum savings on that initial gain is?
So the maximum savings on that, I guess I'm not sure if I'm understanding the question.
You're calling it a haircut.
Yeah, so
The maximum amount of the haircut.
is that 15%. Yes.
15%.
So the 10 and the 5.
Lose, so.
I don't like haircut either.
It's not complete elimination. then.
No, it's 15%.
It's 50%
So his
on the first investment,
on the first investment.
and then the rest is 100%. Now, if you hold it
The
at 10 years-
appreciation beyond. So the simple example is I've got $100 of gain. I invest that $100 of gain. I wait to 2026. I pay tax on the $85 of that gain, and then anything after that $85, appreciation after $85 through 2047 is tax free.
So just to be clear, years 1 through 4, you're not paying any tax on that gain, correct?
Years 1 through 7.
What was his
Or
question?
sorry, Mark's question was, years 1 through 4, you're not paying any tax on that gain. You're not paying tax on that gain until the earlier of at this point, 7 years or 2026. So if you do your investment this year, then it's 2026. If you do your investment after this year, then you're gonna get less of that 7-year benefit.
Maybe you could just spell out what the best process would be. Like, to me, the best process would be to 1031 exchange the opportunity zone into something else so that you don't take that tax hit, right? Even though it's a haircut,
But it
One-
depends. It depends what
So
you're
here's-
starting with.
Yeah, so maybe it's a good time to segue to that. So the question was, strategy wise, does it make sense to 1031 out of the opportunity zone before you get hit with that tax? If you transfer out of the opportunity zone, even if it's a 1031 exchange, you will trigger that gain anyway. So you're gonna lose that benefit regardless. But kind of, how can we make opportunity zones and 1031 work together or get in, get out? So what we talked about before was if you've got a crypto gain, stock, whatever, you buy real estate. Now you're a real estate holder, you've got that asset, it's appreciated. You've gone your 10 years, you've gone your 15 years, you've gone to 2047, you've got gain that you're gonna have to recognize. Then at that point, or any time after you've gotten your benefit, you can always 1031. You're gonna trigger gain at a certain point, but it might be reduced gain. You might get gain elimination if you've waited 10 years. But at the end of the day, the bottom line of all this is the tax, be it a 1031 exchange, be it an opportunity zone, shouldn't be the driver of the transaction. So if opportunity zones are looking good right now, but in 5 years that neighborhood has gone to shit, sorry, and you need to get out or you want to get out before it gets really bad, then get out and don't hang in there for 0% gain, 0% tax on $0.
And the two structures, 1031 exchanges and opportunity zones, may or may not go together. So we get a lot of calls from people who say, I own real estate today and I'm selling it, and it's rental, investment, or business use property, and I want a 1031, well, I want to defer the tax is really what they're saying. Can I do a 1031 exchange into an opportunity zone? The answer is it depends. In most cases, if you're selling an asset in 1031 exchanging, to get into the opportunity zone, you're going to buy into an opportunity zone fund, which is not considered real estate for 1031 exchange treatment purposes. So usually if you own real estate today, you have to decide, do you want to remain in real estate, and then you're probably going to 1031 exchange into other real estate. I think from a 1031 exchange perspective, where the opportunity is if the exchange fails. So if you sell property, do a 1031 exchange, you can't find property you like, you don't identify property, or maybe you identify property and for some reason you can't complete the purchase, so your exchange fails and it becomes taxable, then you look at taking the gain and putting it into an opportunity zone as a backup strategy to save the tax liability. Then at least you could defer it for 7 years, and then any additional profit on the new investment will be tax-free after 10 years.
And so let's say you start out with the intent to 1031 exchange, you put your money with Exeter Exchange as the exchange accommodator, and you blow your 45 days, you're unable to identify a property.
So what is this 45-day rule?
I think we're backing up. So for those who haven't done 1031 exchanges before, you've got some time frames to worry about. So when your sale escrow closes, that triggers your 45 calendar days to identify what you're going to acquire. So if escrow
Calendar
closes,
days.
calendar days, so
Includes
exactly
holidays.
includes holidays, weekends, and birthdays.
Damn.
I know. Hate when that happens. So if your escrow closes today, then tomorrow's day number 1, you got exactly 45 days to identify. Well, if that time frame comes and goes and you haven't found property you like and you fail to identify, then the 1031 exchange fails, it becomes taxable, but the opportunity zone may be a recovery vehicle, if you will, to take your gain, go reinvest in an opportunity zone fund, and at least be able to defer the tax for 7 years at that point.
So if you blow the 45 days, what happens to the money? Does it sit with the exchange accommodator?
We'd have to hold the funds for the 45-day period, and then if there's nothing identified at the end of the 45th day, then on the 46th day, we'd release the cash to the client. So at that point, you could receive the cash and go from there into the opportunity zone fund. Prior to today's event, we were kind of talking about the fact that if you're a qualified intermediary, and let's say the client has identified 3 properties as part of their 1031 exchange, and then for some reason they decide not to or can't acquire those 3 properties, so the exchange fails, because they've identified property, under the Treasury regulations, we're not allowed to release the funds until the 181st day. And for the Opportunity Zone Fund, you have to reinvest the funds no later than 180 days. So kind of creates this conundrum, and what happens, and the regs just came out a week and a half ago. We were hoping there's something in there would address that issue, and I don't think they've even thought of that issue yet. So we're kind of brainstorming options. I'll let you kind of jump into your idea on how we might be able to fix that.
Right, so the new regs did come out last week, about 179 pages, 169 pages. I've gone through most of it, so it doesn't look like the answer's there. It might be there, but regardless of that, if you guys recall earlier, I mentioned the partnership rules and where partnerships come into play. And if you have your gain coming through a partnership and recognized at the partnership level or at the partner level. So if you've got an LLC that's taxed as a partnership and it blows its 1031 on January or whatever, June 31st, June 30th, the money is then returned on July 1st. The partnership, the LLC, has until the end of the year to do something else, to do anything else. At the end of the year, it's going to report, look, we blew that 1031 exchange at the beginning of the year, so you have gain. You got to report all that gain, partners. And so the partners can then, December 31st, have a new 180-day period to go do an opportunity zone investment. So I guess what we're highlighting here is if you're gonna go into a 1031 and it's possible that you want to avoid that risk of blowing the 1031 and you don't want that gain exposure, then a backup plan is just make sure you've got all of this happening through an LLC with at least 2 members. And you just need a minority interest, for that second member to lock in the potential to be able to roll it into an opportunity zone if the 1031 doesn't work.
Interesting. So when you say I found an opportunity zone fund, right, and they're investing in different properties around and they're taking money from investors, almost like a syndication. Do I have to have sold something in order to put money into that opportunity zone fund in order for it to be, or, is it specifically for, I have a gain from something I just sold, I'm putting in here, or can I do it like a crowdfunding thing and say, I got $5,000, I'm gonna put it into this opportunity zone fund?
So the question is, basically, do you need to have gain funds to invest and take advantage of the benefits, or can it just be, can you pool some investments and say, we're gonna be an opportunity zone fund and we want these benefits? It has to be gain. So it's proportionate, pro rata, based on the gain. So if you've got $100 of gain money coming in and $500 of non-gain money coming in, it's still gonna be pro rata 20%, or whatever that percentage is.
So I can put my whole $600 in, but really $100 is.
That's the only portion that's gonna get the benefit of deferral, elimination, reduction, all the things.
Remember who made these rules and why he made the rules.
Yeah.
Go ahead, John.
Yeah, can you go over the substantial improvement, again, the rule that you have to substantially improve the property and the basis for that? Is it the improvement value only?
Sure.
Has to double or match the land value?
Right, the rule.
Question is.
I'm sorry, yes, the question, thank you, Jim. The question is, review the substantial improvement rule. So the substantial improvement rule is basically whatever the value of the business, the opportunity zone property is, be it business property or real estate, then you have to invest 100% of the value of that property in improving it over the course of 30 months. The value when it comes to real estate is just the building value, not the land value. So if you buy something that's worth $1.5 million and the building value is $500,000, the land value is $1 million, you have to put in another $500,000, the building value.
Where does that value come from, the tax assessor or?
Yes.
So whatever's on the tax assessor's roll.
Right. I mean, you could argue if you could get an appraisal, a separate appraisal, and if it's a separate independent appraisal, you could argue that the property assessor is wrong. This is the real.
And remember, it varies by location too. For example, we do a lot of investing in Minnesota, and in Minnesota, land value customarily is only 10% of the purchase price. So it's very different.
Just real quick, as kind of opposition to that, talk to us a little bit about how 1031 Street putting repair money into, what's the process for that in 1031s?
Meaning putting repair funds or improvement funds into the new replacement property.
Yeah.
So that's referred to as an improvement 1031 exchange, or other folks call it a build-to-suit or a construction exchange. So effectively what happens is you sell an asset, do a 1031 exchange. Let's say you sell your asset for $5 million. You do a 1031 exchange and maybe you buy dirt for $1 million. So you've sold for $5 million, you've acquired dirt for $1 million, you've got 400,000 or 400 or $4 million left to reinvest. In that case, you could do an improvement exchange where the qualified intermediary would acquire and hold, or what they call park legal title to the new property. And then you'd have the rest of the 180-day window to spend the $4 million and complete the construction. So 6 months is a really tight time frame. If it's a ground up project, it's probably not going to work. But it's not an all or nothing proposition. So with a build-to-suit exchange, what matters is what is paid for and completed. So in that example, you sell for $5 million, you buy dirt for $1 million. Let's say you get $2 million worth of improvements completed by the end of 6 months. That $2 million would count and would be deferred through the 1031 exchange, and the $2 million you didn't reinvest or didn't complete would be just taxable boot. So obviously the further along you get, the more you can defer. So that's certainly possible. It's the 6 months makes it a little challenging, so it depends on what the project is and what you're trying to improve.
Mayor, I have a question on the, if you hold it for 10 years, you get a complete step up in basis. Does that apply to the amount that you're depreciating or taking a cost recovery write-off during that 10 years?
Yes. So you could be depreciating this asset and getting that cost basis down to zero through depreciation, and you still get to have gain elimination apply to the whole thing.
So you get the double depreciate?
Basically.
Can you walk us through that?
That's awesome.
What that would look like? I'm sorry.
So this is something that was clarified last week. So very kind of rough, in rough strokes. The rules are allow for gain reduction, elimination, deferral. So if we're taking the example of I've held for 10 years, I've invested my $100, I've gotten my 15% reduction, so I've got $85 of gain that I'm deferring. That gain is, you're gonna pay tax on that gain, but now the fair market value of the property in 10 years is 150 or, let's call it 200 just for even numbers. So I've got 200 of gain that 200 of fair market value that I'm selling for, and I've got 85 of basis. So that 115 of gain is the first layer that is being eliminated at that point. Now, during the course of this 10-year period, I've got basis in that asset that I'm going to be depreciating, just like any other real estate asset. That depreciation doesn't get calculated into that gain that you're recognizing. So it's
not going to lower the basis.
It's not going to lower
isn't
the
gonna go
basis
down.
beyond that 85.
And you're still permitted in these scenarios to do a cost segregation analysis and accelerate the depreciation.
Yes.
But that'll be recaptured though. That portion will be recaptured.
No.
Oh.
No. So you would be able to put your 85, you put your 100 in, take your depreciation, defer gain, eliminate gain, and then ultimately, you're kind of double dipping, but that is one of the benefits there for real estate.
I have met several people recently who are buying properties, sometimes vacant lots, and lots more often than not, 2 to 4 unit properties often in opportunity zones. And they're putting putting plans and permits in place and entitlements and flipping them for significant profit with the existing structure on them. Would something like that count? Would the amount of money that has been put into plans, permits, entitlements count towards the 100% investment improvements, or would we not be able to count that?
Well, if they're going to turn around and flip it,
Still not gonna.
they're not going to be holding long enough to actually take any benefit from this.
It's inventory.
And yet, sometimes they're keeping these for a couple of years and collecting rent if it's cash flow.
So yes, I mean, I think it would apply. You can make the argument that it's, first of all, you've got a 30-month period. So if they're holding it for a couple of years, 2.5 years, they've got time to play, right? So they can go through this whole process and drag their feet, and then the 29th month sell. So, okay, they've gotten the benefit of the gain deferral. I think if you've done enough in terms of getting the process going, there's a lot of nuances to this I can go into, and one of them is working capital, where if you've got a plan and you're showing that you're trying to get the improvements in place, then you're deemed to have satisfied that substantial improvement requirement, even though you haven't necessarily shelled out that 100%.
Do the funds, like with a qualified intermediary and a 1031 exchange, the improvement funds have to sit with the QI, correct, or not?
Yeah, well, if you're doing a 1030 or an improvement 1031 exchange, then the sale proceeds would have to sit with us. In a lot of cases, when they're doing improvement exchanges, they're actually putting additional funds into the project as well. So we would only hold the funds that are directly resulting from the sale of the relinquished property. Any outside funds, whether it be out-of-pocket funds or construction financing, would be probably contributed directly to the project and not through us.
So in your example, that 4 million, say that was extra, 2 million of that, I would have to invoice you and say, hey, we need you to pay for lumber, we need you to pay this.
Exactly, yeah.
And what about in an opportunity zone? Are there any qualified intermediaries or other types? What happens with, where does the money come from?
Yeah, with the opportunity zone, it's much looser. It's, you control everything. It's self-certified. So in order to create an opportunity zone fund, you set up an entity, set up an LLC, and you call it your opportunity zone fund. You designate. There's a form that's filed with the tax return. So you kind of have like a year and a half, basically, to say, I'm going to make this entity an opportunity zone fund. And the next step is create a bank account in the name of that entity, put the funds in there. You're controlling it, you're managing it. You're just going to report to the IRS on the tax return for that next tax year. I've created this fund, this entity. I want to treat it as an opportunity zone fund, and here's the amount of gain that I'm deferring. Here's the amount of gain that I've invested within the 180 days. And there's rules with respect to how you measure that investment, half-year mark, year-end mark, a lot of nuts and bolts, but let's save that for later.
Other questions?
Which one's better?
It depends.
Keep in mind too, I covered the qualified use requirements. So properties that don't satisfy the 1031 exchange requirements, rehabbers, flippers, developers, builders, would qualify for the opportunity zone. So for a lot of you who are flipping property,
It depends.
It depends.
I want to actually, you made a comment about your flipping, and one thing to realize or be aware of here is it's gain deferral, not income deferral. So if you're deemed flip, you've got on your tax return as a capital gain, then it works.
Right.
But if it's something that's going to be treated as inventory or ordinary income, this doesn't work. And if you're operating a business, if you've got rental income within the opportunity zone, those are still treated as normal. You're not getting any deferral or any reduction on the revenue that's generated from the business or the property that's within the opportunity zone. Does that make sense?
Yeah, so if I took some of that money and I bought a duplex in Culver City and then decided to run an Airbnb out of it, you're saying that the money that I make from that said Airbnb will not be tax deferred, that'll be taxed. But the fact that I'm holding that property and the amount that goes up over time will be tax deferred and possibly lessened?
Correct. So to clarify the question, if you've got a property that you turn into a rental or Airbnb, the rental income, the revenue that you're generating is taxed as ordinary.
Right.
The appreciation, the value increase in that property over time is what's going to benefit from the potential gain elimination.
Okay. Thank
John?
you.
What determines whether it's ordinary income or capital gains?
That is, that's a very complicated question. That really, it depends. What it comes down to is, in the ordinary course of business, your revenue from working, your W-2s, your profits from operating a business, that's typically ordinary income. Capital gains are on the sale of property that's treated as a capital asset, that's for investment purposes. So if you've got stocks, bonds, crypto, art collection, things that you just held on to and then you sell, that's usually capital gain. Real
But
estate.
in the real estate part, when you said on a flip or whatever.
Well, on a flip, as Bill alluded to earlier, what you can have is, if you're a developer or if you're in the business of constantly flipping properties, then you could be treated as
Ordinary income.
you treat it as in the business and it's inventory, and if it's inventory, it's treated as ordinary
Is there a
income.
number that triggers that, or is there some
There,
threshold?
it's not a hard and fast intent, I think, is part of it. So,
Always boils down to intent. Question?
yeah, other questions?
So as long as, let's say you have separate entities for, one for dealing, and then one where you bought with the intention to hold, they aren't gonna look at like all the entities that you're involved with as a whole?
Good question. So the question was, if you're really executing multiple strategies, so some buy and hold, some fix and rehab and flip or something like that, and you have them in separate entities, how would they look at that? From a 1031 exchange perspective, they do not look at the total picture, they look at property by property. Although what you've just described is probably a really good way of structuring your operation. And if you get audited, you can say this LLC always buys and holds, so it always qualifies for 1031 exchange treatment. This LLC is always a flipper. And if you can show that and you don't cross-pollinate between the two, it's really easy to prove intent. If you start to deed property back and forth or mix the two, then it gets ugly during an audit.
What if we have a banner LLC, my partner set it up, so we have the banner LLC, and then we have one for remote wholesaling, and then one for the rental portfolio. Are they gonna, if they see the banner LLC has?
No, they're really gonna look at property by property. The banner LLC is like a holding company or a holding entity, and then you've got two subsidiary LLCs. One is a fix and flip, and one is a buy and hold. So I think that's still fine.
What's the chance of an audit?
Good question. So at the federal level, the audit ratio is really low, especially for 1031 exchange treatment, and the IRS has all sorts of budgetary problems, so their audit staff has been cut. However, at the federal level, we're not terribly worried about audits, and they're usually pretty reasonable. However, at the state level, California literally has put 1031 exchanges on their top 10 list. So California is actively auditing 1031 exchanges. However, it seems to be that they focus more on syndicated tenant and common investment properties, syndicated partnership type structures. They'll never tell us, so you're always trying to find that threshold. They audit everything above a certain dollar. It seems to be everything above 5 million. We just tell people, just plan on being audited. Make sure you dot your I's and cross your T's because you're in California.
And does that apply if the down leg or up leg is in California, or does it also apply if the investors are in California but the real estate's outside?
It's really going to be if the investors are in California, so they're California taxpayers, or the relinquished properties in California. If you're selling an out-of-state property, exchanging into California, you have to wonder why sometimes, but because you're exchanging into a hornet's nest, it won't be an issue at that point in time, but it will be once you relinquish that. The other thing to keep in mind is if you're selling California real estate, doing a 1031 exchange, and you're acquiring replacement property out of state, California has this thing called what we've nicknamed the California clawback provision. So California always takes the position that you own California real estate, you've got a gain in California, you sell, you do a 1031 exchange, it's tax deferred for federal and state purposes. In the future, if you sell and cash out and pay the tax, then California wants their quote unquote fair share. And you do have to report the status of that property every single year going forward to California. If you fail to report, they will estimate or guesstimate your taxes and go after you. So it's not really a horrible thing, it's just kind of a pain. If you never sell and cash out, so you always 1031 exchange over and over, what we call swap to drop. Or if you pass on and leave the property to somebody in California, it never gets paid. So it's only when you decide to sell, stop, exchange, and cash out that California gets paid.
One thing that kind of came to mind was, California in particular being very aggressive with their audits, drop-in swaps, where we kind of see situations where you've got multiple owners of an LLC, and someone wants to 1031, someone else doesn't, wants to cash out, or they can't agree on the next property, and they want to go their separate ways. So one of the common structures is the drop-in swap. Do you want to?
Sure, and historically, going back many years, it was the drop-in swap was the solution. You would have an LLC or a partnership with multiple partners, and they couldn't agree on what to do, so you would drop the real estate out of the entity by deeding it to the individual partners or members as tenants in common. So you've converted a partnership to a tenant in common relationship. Then you would sell the property and do a 1031 exchange. Well, you'd sell the property and then each individual could decide what to do. Some would 1031 exchange, some may cash out and pay the tax. There's a couple of cases they would look at, the Magnuson case, the Bulker case, etc. The challenge with those is those cases were under the old California Partnership Act. And so we're not sure the court would rule the same way today. So when you do a drop-in swap, effectively the issue is you're dropping property out. The partnership could easily show that it had the intent to hold for investment, because it did for years probably. You drop the property out, the individual takes title, and then you immediately sell and do an exchange. The individual never intended to hold for investment. They held title just to do a 1031 exchange. So the risk there is under audit, they would disqualify the 1031 exchange. So there's a number of solutions there. One is you do the drop, deed the property out to the individuals as tenants in common, and then hold as individuals for 24 months. Now that's my opinion, is 24 months.
But it's all about intent.
It's all about intent. At 24
So if I write
months,
you a letter that
intent.
says my intent is to hold this forever, even though it's being sold the next day, my intent is to hold it forever.
You in big trouble. So if they could prove intent for one day, it would certainly work. But if you've already got it under contract, I think you're in big trouble.
You probably don't want that exposure. I mean, the point is, you might have your facts, you might have everything to prove your intent, but the presumption is if you hold for 2 years, then general consensus is you're less likely to be questioned. Mm-hmm. If you do it after a day or after a month or 6, there's just a higher chance that somebody's going to come ask you.
Yeah, and the IRS amended the partnership tax return, the 1065 in 2008, and they specifically asked on the tax return, have you dropped property out and then immediately sold and exchanged during the last 2 tax years? So we know they were specifically targeting those issues. Sorry. But since then, they've actually taken those questions off of that. So we don't know what that means. We don't know why they took that off the list or off the tax return, but we still think it's definitely an issue. So you want to be very, very careful when you're doing that. There's all sorts of other potential solutions. You can do the opposite. You can do a swap and drop. So the partnership or the LLC could sell the property, do a 1031 exchange. Each individual partner could identify their asset, but the partnership would buy the various replacement properties, hold it for 2 years, prove the intent to hold, and then each property would be deeded to one of the partners, and you dissolve the partnership or something like that. So that's an option. Sometimes you have a situation where a few of the partners do not want a 1031 exchange. They want to cash out and go their separate ways, and the rest want to stay together in the partnership. So we might be able to do some kind of a redemption agreement where you effectively buy out a couple of the partners. You pay for the buyout by deeding them their percentage of the real estate. And then when escrow closes, they're getting their proceeds, they pay the tax, and the partnership owns a smaller percentage of the property and does a 1031 exchange on that portion. So there's probably maybe hundreds of variations there depending on the fact pattern.
I mean, the couple of things I'll add to that is, yes, a refinancing if it's possible, and then buying out the individual. But the opportunity here is to use opportunity zones. So you've got the partners that want out and the partners that want to keep flipping. And if they can't wait, and they don't want to wait, and they just can't stand each other, then opportunity zones might be the answer, because the people that want to recognize the gain will recognize the gain. The people that want to stay in real estate could just go find property in an opportunity zone and keep deferring and taking advantage of these rules, and ultimately 1031 out of the opportunity zone if they need to, and keep 1031ing down the line. There will be some gain, you're deferring, you're not eliminating, that will have to be recognized in 2026, but that might be more palatable than being stuck with a worse situation or a bad partner.
So just if you invest in an opportunity zone fund, as I guess you'd be a limited partner, right? A fund that's actually going out and buying, doing all the real estate stuff. Can you 1031 out of that situation, or would the whole thing have to?
So when I say fund, it's not fund in the traditional sense of an LLP or an LP structure. Sorry, Mark's question was, when you are investing into property in a fund, do you have to sell? Do you have to sell the? I guess I started answering it too fast, and I'm not rephrasing. Can you rephrase your question?
So I actually, so somebody had asked, can you go out and find funds that are actually doing this stuff and not do the work yourself? So if I take my gain and I find a group that's actively investing in opportunity zones, I put my money with them. I'm a limited partner, correct? I'm passive.
Right. So if you've invested into a fund, an existing fund,
Right.
then you are a limited partner potentially, or a member of that LLC or a shareholder of that corporation.
So in the same way, in order to 1031, that whole thing has to 1031 out at the end of.
So the question is, how do you 1031 out that investment? So really what it comes down to is your investment into an opportunity zone fund gives you all these benefits. The opportunity zone fund, again, is the traditional fund concept of somebody else has put together a fund and you're buying in. But more typically, or more appropriately, it is you setting up your own entity that can then invest in that fund. So start with your own entity, start with your own LLC, your own corporation. That is your opportunity zone fund. That should be your starting point, because that gives you additional flexibility. Where the gain has to be recognized and it's triggered is when you've sold the interest in the opportunity zone fund or the sub fund. And so if you have your upper tier fund, that's your fund, your entity, and it has an investment in a sub fund, and you sell that, then you've got the interest in real estate, potentially, depending on how that is held, to convert into a 1031. It goes back to those overall rules for 1031, where you've got to have, you're not exchanging an interest in a partnership or in an LLC, you're exchanging an interest in an underlying property. So if you are invested in another entity through your sub fund, then 1031 is not going to be as easy. You're going to have to take a couple extra steps. But if you're buying some real estate, then that's where it's going to work, or work better.
Any other questions?
I have one more question, just real quick. So I love the idea of the wealth building. This is what's always been taught, the wealth building cascading up with 1031s, right? You just take your equity, and literally every 2 or 3 years, the appreciation could get you the bigger and bigger properties, and then even if you die, your kids can just take that, and go forward with it. You mentioned that you don't think that the opportunity zones are going to go anywhere past. They're going to probably here to stay, correct? This law, because right now, isn't there a cutoff time of like 10 years or something like that?
So they're in play until 2026. You could take advantage of these rules by investing within this time frame.
So then after, it can go from 2026 to 2036, it can extend out.
So you invest up until 2026. You need that at least 10-year hold period, and it ends in 2047. So the appreciation that is going to be treated as tax-free stops accruing in 2047.
So it's only appreciation that is deferrable. The cash flow is not, right?
It's only the appreciation that is eliminated and in that upper level. So let me rephrase your question. the question is only the appreciation deferred, or is it the income? So the income is not deferred, the income is not eliminated. The rental income, the operating income, the business income, it's taxed as normal. The appreciation.
What does normal mean?
As if you weren't in the opportunity zone.
Is it regular income? Is it K1?
Whatever it would otherwise be.
Okay.
So depending on if you've got rental income coming through a K1, if you run a business, it's on, whatever that
Dividend or whatever.
Yeah. But the appreciation that's accruing, the value increase in that asset is what's going to benefit from that gain elimination. So if that asset goes from being worth $100 to $200 or $300, that growth is what is going to benefit from the tax elimination.
How is that new basis calculated in 2047? Is that through an appraisal or?
Yeah, I mean
you have to get an appraisal to
would
prove that this is the new basis.
The fair market value at that date and time is what you're going to get a step up
Based
to.
on an appraisal.
Right.
So government does those incentives for people to invest in opportunity zones because people wouldn't invest otherwise. Is it a bad investment or?
Well, that's kind of the
You got to do your
so the
homework.
question is, did they do this so people would invest in these bad areas that there's no money otherwise going into? And yeah, that's the general idea, is let's make an incentive for money to come into these lower income areas, these poverty stricken areas. But what we've seen is the way the areas have been identified, that there's areas that are already popular, gentrified. Koreatown, Hollywood, the area around the Coliseum where the Olympics are going to be in 2028. I mean, that area, I don't think should have a problem appreciating in 10 years, but I'm not a real estate guy. Then beyond that, I mean, if you just are looking in Southern California, there's some opportunities. I've got clients that are in San Diego, up in Northern California, that are looking at Oakland, that are looking in around the, I think there's actually an area in San Diego that's just on the other side of the ballpark. So everything in like the Gaslamp district is not opportunity zone, but 2 blocks over is. So there are these pockets, and then also keep in mind that this is across the country, and there's areas where you could buy land, invest in land, and you're waiting for appreciation, but you've also got these other rights, mineral rights. If you're going to put a solar farm, if you're going to invest in biofuel production. I mean, I'm seeing clients doing a lot of different things. Oil and gas properties in Texas we're seeing kind of very popular. So land, I mean, you could do a lot of things with it. You could still do a 1031 and then roll out into, do an opportunity zone to get in, and then roll out into a 1031 down the line.
A way to find the, say you wanted to take the passive approach, is there a way to find the funds that are operating that you can invest in?
Good question.
Yeah, there's websites, I just looked at some up today. Just Google.
So the question was, are there funds available to just passively invest?
Well,
And
if
you Google,
but how do you
Come to more FIBI events.
yeah, I mean, I think what it comes down to is, as Mark said, you look online, talk to people, see what people are doing. I've got a couple of clients that are doing it, that are looking for investors, but it's at this point kind of word of mouth, and there's probably some directories or some resources, but I'm not totally attuned to them personally.
And like you said too, some of the big banks are putting together funds. Some of the syndicators that are doing the Delaware statutory trusts are beginning to put together funds. So they're out there and they're just starting to come together. So I think it's a matter of time before there's a couple websites that'll just list everything.
Do the same accredited investor rules and sophisticated investor rules apply to opportunity zones?
No, anybody can do an opportunity zone.
So why don't we just wrap it up by each of you telling us at what point should somebody who's considering either a 1031 or opportunity zone get and contact you, and anything else you'd like to add?
Well, I think from a 1031 exchange perspective, the key point is you have to have the 1031 exchange in place before the sale or the purchase closes. So it has to be in place before anything happens. But before you even put the transactions together, questions come up. So I really think the best thing to do is kind of going back to some of the things we said, you really need to be looking at what is your exit strategy before you buy, and then have your team together, and we're part of that team. So anytime you're getting ready to sell, start asking questions ahead of time. Frankly, a lot of clients will call us, a week before escrow closes, and that's when we find out we have a partnership issue to deal with, or an LLC that's treated as a partnership. And then it's really difficult to solve problems with a limited amount of time. So as soon as you think about selling and doing an exchange, call us, walk us through the transaction. We can point out any potential issues.
I would say call Bill even before that, because you've got those issues with drop-in swaps. So if you've got multiple members and you've got partners that you want to retain flexibility, then you want to start that process even earlier and have some of these pieces in place so that everybody is kind of flexible and has their options. And yeah, with respect to Opportunity Zone, I mean, I touched on a lot of the high level. There's a lot more information out there. I've got a PowerPoint presentation that kind of summarizes a lot of the details. So if anybody would like that, I could share that. But you can Google it. You can find out a lot of these rules as well, just the basic rules. And the point is, reach out to us if you have questions. I mean, that's what we're here for. We're here to educate you guys. And if you have follow-up questions, if you have concerns, feel free to reach out to us. And ideally, the earlier we have these discussions and the earlier we start to look at the potential and understanding what your goals are and what you're trying to do, the better equipped we are to make it efficient and effective.
And Bill, you have some of your booklets in the back with your contact information?
Yes, so there is a guide to 1031 exchanges in the back. It's about 30 pages, looks like this. Thank you for that. And that'll walk you through all the basics, and also has our contact information, so feel free to give us a call.
And Mary, your info's on our meetup page if anybody's interested, but you also have, I'm sure, have some business cards too.
Yeah, I mean, if anybody needs old school business cards, I've got those, or find me online. So
cool. Well, thank you both so much. Really appreciate it.
Our pleasure.
thank you guys for coming.
Yes, thank you for coming. Only